There's the closing bell on Wall Street, and now it's market domination overtime. We're going to be joined by Jared Blickery to get you up to speed on the action from today's session. First, I'll start with where the major averages ended on the day, and it's not much different from what we saw in the past hour or so. That is not much change for the three majors today. The Dow moving the most, but a paltry third of 1%, down about 119 points here. The S&P 500, very little changed, as was the NASDAQ. Pretty much, you got to go out few decimal points to even get any kind of numeral there for the NASDAQ's change day. As we've been talking about, the market's kind of in a pause, wait and see period when it comes to more tariff headlines, and this ahead of meetings between U.S. officials and Chinese officials in Switzerland over the weekend. We shall see what that yields. Jared, give us a closer look at today's action.
Thank you, Julie. It was a fairly quiet week by modern historical standards, and that includes a Fed announcement. So there you go. Here's the NASDAQ. This is a 5-day total, down just fractionally, just a little bit more than 0.25%. Here's the Dow, down a little bit less than that, and the S&P 500 down less than 0.5%. We'll also go to the Russell 2000, see where that lands, and that's actually positive right now. So go figure. The VIX has been intriguing me. This is a 5-day look, and we are closing at some of the lowest levels in the week. But actually, if you put up the year-to-date chart, you can see this is the lowest level, at least on a closing basis, since April. And then we took a look at the ICE B of A Move Index. That's like the VIX of the bond market. That is at the, I think that's about 5-week lows right there. And we can also check in on the 10-year T-note yield, which is up net this week, just a little bit, but still around 4.33%, or 4.38%, excuse me. Let's get into the sector action, check out some of the heat map action. Energy is up 1% today. That's on the back of a rise in crude oil, which had some gains this week coming from pretty depressed levels, almost 4-year lows. Healthcare was the biggest laggard today, and we'll check out the sector tallies for the entire week. Healthcare, after having a couple biotech stumbles earlier, that was down 4.2%. Industrials takes the cake for the winner, up 1.1%. Nothing else up more than 1%, and nothing else besides healthcare down more than 1%. So again, another kind of sideways action week here, and a bit of a respite for investors because it has been rocky over the last month or two. This is the 5-day total. Let's get back to the intraday so we can see what happened today. Tesla up 4.72%. That is one of the few outperformers here. A couple other dark green squares. Looks like Texas Instruments up 4%. Marvell up 3.5%. To the downside, we're looking at CrowdStrike. That's down 4.21% today. And we can also take a look at the Dow, and we see a mixed board. Besides the mega caps, which we were just looking at in the NASDAQ 100, United Health down 1%, 1.3%. Chevron up, though, 1%. That's that energy trade I was talking about. IBM down 1%, Amgen down 2%. So kind of ho-hum there. And let's close and see what's happening in China, because we've seen that in fits and starts over the year. And looking at a mainly red board for China, and just the 5-day total real quick, still looking pretty red. Send it back to you, Josh.
Thank you, Jared. Well, joining us now is Michael Sayers, Rockland Trust Vice President and Portfolio Manager. Michael, thank you for being here. You say, Michael, there's a combination of 3 things that need to happen if we're going to avoid a recession. What are they, Michael? Walk us through them.
Sure, absolutely, Josh, and thanks for having me. Well, even though the economy, I think, has some decent momentum, coming into the second quarter here, we know there is going to be, a lagged effect, a slowdown here from the lack of trade that's been happening with China and our other trading partners. So I think what we need to see over the next couple of months is, certainly some trade deals. The market got excited yesterday when we saw the agreement with the UK. Personally, I was a little bit underwhelmed by the result there. But of course, the big one is going to be China tomorrow, whether we can make some progress on the tariffs there, bring those down from that 145%. So we're going to need deals with a lot of the big trading partners over the next couple of months. Lower interest rates will help. Obviously, the Fed did not lower rates this week. We'll have another chance in June to see if they do that. And finally, we need to see progress on the tax bill, which is currently working its way through Congress.
What do you think is the likelihood, Michael, of each of those 3 items?
Well, I don't know if we need to get all 3, but I think we're certainly going to see deals. I think the question is the market, are the deals going to be good enough for the market. So getting back to what I said earlier about the deal with the UK, the UK was in the best position to negotiate tariffs lower than 10% out of any of our trading partners, and even they got stuck at 10%. So that concerns me a little bit that all our other trading partners are going to be above 10% and maybe significantly above. So we're going to need to see better deals than the one that we got with the UK. I think lower rates is probably the least likely. I think given the Fed's concern around the tariff impact on driving up prices and inflation, they could easily hold again in June, and then the tax bill. That's a wild card. I don't have a great read on that. We'll have to see what comes out over the next few weeks.
Michael, let's get to some picks here. I'm interested where you see opportunity. One is ticker ECL. Walk us through why that's a buy, Michael.
Sure. So that is Ecolab. So it's the leader in essentially cleaning and sanitizing products and services. They also are doing a lot more in pest control. So they've got a very diverse end markets in terms of the types of businesses that they sell into. So that makes for a very stable revenue profile. They've got strong pricing power. They actually announced a 5% trade surcharge to offset the negative impact from tariffs that they expect to see. And there's unlikely to be any effect on volumes for that because the switching costs are so high for customers. They've also got some cost efficiency and productivity programs. So we expect to see more margin increases there. And ultimately, we think this is a company that can do double-digit earnings growth over the long run.
Michael, how about NextEra Energy, right? We had seen sort of last year a lot of the various utility type companies, power generators do well on the back of the AI data center trade, but then a lot of them, including NextEra, have sort of come back down quite a bit.
Sure. So NextEra, it's a little bit of a contrarian call for us here. So one of the biggest utilities in the U.S., we think they have an advantage relative to their peers in terms of the supply chain. They actually just signed a new contract with a domestic battery supplier, so that will help them offset some tariffs in the near term. Ultimately, we're cautiously optimistic that there won't be a full repeal of the renewables tax credits and the Inflation Reduction Act that Congress is currently looking at. So, despite some potential headwinds that might be out there, we think this is a company that can grow earnings 6 to 8% over the long term. That's about as good as it gets for utilities.
Final pick here, Schwab. Walk us through that one, Michael. Why do you see opportunity in that name?
Sure. So Charles Schwab, giant broker, about $10 trillion of assets under management. We think they benefit in the near term, actually, because of the volatility in the markets. When this happens, investors tend to trade a little bit more, and or seek professional advice from advisors at Schwab, and that certainly showed up in their first quarter results, which were stronger than expected. And then longer term, we think they've gotten to the point where they're past most of the customer attrition issues from the TD Ameritrade acquisition a few years ago. And now they're in a better position to return to mid-single digit net new assets growth. And that's going to help them do mid-teens earnings growth over the next few years.
Michael, thanks for bringing us some picks. Appreciate it.
You're welcome. Thanks for having me.
Take care. Well, markets are calming as President Trump gradually backtracks on the most strident elements of his trade war. So scratch that recession, says Yahoo Finance's Rick Newman. He's joining us now with this week's rendition of Trumpanomics. So we're in the clear, Rick?
We're in the clear this week. That is where we stand on the Wheel of Fortune, I guess, based on the latest spins. So, a lot of the economists I follow are saying, okay, this is getting marginally better. Ed Yardeni, for example, an economist a lot of people follow, recently lowered his recession odds from 45% to 35%. Now, at the start of the year, they were only 25%, so they're higher than they used to be, but it's moving in the right direction. And the reason is obvious. We saw a little bit of progress this week on the trade war with the kind of fig leaf deal with the UK, and then Trump saying maybe 145% tariffs on Chinese imports is a little bit too high. It's like way too high, but at least Trump is now acknowledging that. So, guys, this outlook obviously could change tomorrow, or anything could happen, but we are sort of seeing more signs that Trump realizes he's got about 2 months to make some progress on this trade war, and that clock is ticking.
Can I ask you a separate question, Rick? And this certainly got a lot of attention today. Trump sort of suggesting here he's open to hiking taxes on wealthy Americans. This was this Truth Social post this morning. Said he would, his words, graciously accept even a tiny tax increase on the rich. Those did seem to also acknowledge, hey, that could come with some political risks. I'm just curious what you made of that.
Well, Trump's trying to have it both ways, obviously. That's a popular position. It's certainly popular among Democrats and also among some Republicans. And Trump is now a populist. He's not really a Republican anymore. He's a populist. So that's a popular position to take. It also tells you that it's a reflection on the trouble Republicans in Congress are having coming up with the offsetting spending cuts or whatever it takes to justify all the new tax cuts they want to do. So that is a real struggle. Now, I don't think this is going to happen. I think there's basically no chance that Republicans in Congress would ever undo that part of their tax bill, because a lot of those people are still traditional Republicans who favor lower taxes for everybody, and they have some constituencies who don't, wealthy donors who would not be happy about that. So I don't think it's going to happen, but it's as usual, Trump just kind of saying whatever pops to his mind and muddying the outlook for his allies in Congress.
Thank you, Rick. Appreciate it. Have a great weekend.
Bye, guys. You too.
And time is money. We'll explore a unique strategy where time really matters when it comes to trades. You won't want to miss our options playbook conversations coming up. More market domination overtime straight ahead.
Amid ongoing volatility, timing the market may be alluring, but it's not easy. Our next guest lays out an option strategy that uses timing to its advantage. Chris Brecher, Simpler Trading Senior Managing Director, joining us now to discuss in the Options Playbook, sponsored by Tasty Trade. So, Chris, walk us through what you're thinking here on this trade, because it takes advantage of some of the changing dynamics in market structure.
Yeah, we've been using, we call it the 1550 trade, because companies can't buy back stock the last 10 minutes. So that's an SEC Rule 10b-18. And the way we look at it is like Financial Times just had an article about companies are going to go on a $500 billion buyback spree. And they can't, usually companies in the S&P don't buy back stock 5 weeks prior to earnings. But for the opening print in the last 10 minutes, they can't ever buy back stock. So a lot of times, 5 weeks prior to earnings, when you go in the blackout, the preponderance of stocks. I usually started with JP Morgan, which was this time about April 14th. So you go into early, late March. It means to us not that a market's going to automatically go down, because that's what a lot of people think with this kind of thing. Just means bad news and bad charts are more likely to work. And that's what we saw. I mean, you saw what happened. And once the preponderance of S&P stocks could buy back stock, the markets have held up great. So the whole point is, even if they have some lousy news, they're Teflon because they can buy back stock. But you can see the end of the day, almost every single day, there's been great opportunities about shorting the markets the last 10 minutes. So we did like 15 minutes before.
Chris, a different question for you now. VIX still above 20 here. Chris, I'm just curious, what do you think it gets it back down to sort of pre-tariff levels? Call it low, mid-teens.
Yeah, that's a good question. I think it stayed up because the realized volatility stayed up so much. So we like doing the 16 rule. So if you divide the VIX by 16, that's what market makers are expecting, like over a 1% move. Every day, and we've seen like a 1% move every day. If I'm right, we've been showing a chart from a old stock market pro, Justin Mamis, of the sentiment cycle in markets on sell-offs, and it's been adhering perfectly to it, where you get basically you get the rally, you get the sell-off and the consolidation, then you get the second leg that's a panic sell-off like you saw on April 2nd. You get the short squeeze, and then you get for weeks that futz around where you get a very tight range. And I think that tight range will be the realized volatility going down. And I think you'll get the VIX back to like 17. So I think when you get the expected move, the realized move every day of 1%, like today, I mean, if it stayed like this for 2 weeks, I think you'd see that VIX at 16 or 17.
And so, and then what levels are you watching for in the S&P 500 that would sort of go along with that?
Right now, well, I'll tell you, I look at it, we did a Google search, Yahoo search, either. And yeah, I got to be careful there. But when they basically threatened the tariffs with China of 10 to 20%, that was March 4th. So the first thing we're thinking is, number one, the S&P on a daily chart, the 200 moving average is around 5,800. The March 4th statement was right around 5,800. And a lot of prior talks have been 5,800. And believe it or not, the prior bottom before the election, let me go to it and be sure I'm telling you the right thing, but I believe was, survey says, yeah, 5,800, the same thing. So that 5,800 is, I think, about it on the upside, because I don't understand if you say, well, China lowers the tariffs are going to go to 50%. That's still higher than March 4th. So it just seems there's so many reasons for the market to futz around in this area for weeks. And I think it's going to take a gradual uptrend, a tightening volatility to work off any kind of oversold MACD, because we look at oscillators of a weekly oscillator. But I think it'll take that to work off all the bearish sentiment. And you've seen it slowly get worked off, but it's taken a long time this time.
Chris, just got a more general question for you. I'm just curious whether, just sort of the notable shifts you've seen, Chris, in tone, character, volumes, and options trading, given all the volatility we've been seeing.
Well, we've seen a lot of the zero DTE stuff, which to me is more premium selling opportunities. But you can't premium sell the calls because you get these, we call so many people call them tape bombs, positive news out of nowhere, even when the markets look bad. So we've been doing a lot more limited risk, like call flies or put flies. So our risk is limited, but if we're right that the expected move during the day starts to contract, we just try to take some money that way. We did that today, and we've done it most days. But I'm seeing a lot more gambler mentality with the zero DTEs, and overall, premium selling is the way I like doing it. So, but at the end of the day, yeah, we'll buy cheap premium. That will do because of this lack of buybacks.
Chris, always great to see you and to have you on the show. Have a great weekend.
Hey, you too. Thanks for having me on.
It has been a wild week for stocks with trade deals top of mind, and one strategist even told us that economic uncertainty has already been injected into stocks. So what does that mean for investors? For more on what we've heard this week about how you can better position your portfolio, let's welcome in now Yahoo Finance's Inez Ferre. Inez.
Yeah, that's right, Josh. So President Trump this week basically said it's a good time to buy stock now, but go buy stock now, he said it. But look, the Wall Street strategists that we've spoken with this week have basically been very cautious about this. You've had one strategist this morning, Brian Vendick of MJP Wealth Advisors, saying that we are not out of the woods yet, that in the near term you can expect more volatility. Of course, China really is the focus now, and these China talks that will be taking place in Switzerland over the weekend. And you had Ross Mayfield of Baird saying that this has been the big headline is the fact that President Trump has been very optimistic about China, that he has hinted at lowering those tariffs against imports from China from 145% to this morning, talking about 80% tariffs. So this is a lot of optimism for the market that deals will be done and that these tariffs won't be as severe as projected. But you still have a lot of strategists that are saying that some of the damage has already been done, and you could see over the next couple of quarters some of the weakness in soft data going into more of the hard data. And what will that do for earnings, and how will the market respond to this? Because you had Truist Keith Lerner talking about also the fact that there's very little buffer when it comes to how everything is going to go with these negotiations. So if something goes sideways, the market is sort of priced to perfection, so to speak. It's pricing in that these tariffs aren't going to be as severe if we take into account President Trump's words when it comes to his optimistic tone, so to speak, this week, that more deals are coming, that there's going to be a tax bill that also is going through Congress, and that this is a good time to buy.
Thank you, Des. Appreciate it.
Thank you.
Time now for what to watch next week. We're going to start off on the earnings front. We've got a lot of big names reporting next week, including Cisco, CoreWeave, and Walmart. Walmart's going to announce results for the first quarter on Thursday, and I was expecting Walmart's same-store sales to rise in Q1, driven by value-seeking consumers and a strong Easter season.
Taking a look at the economy, monthly CPI, that's of course the Consumer Price Index, coming out on Tuesday. Economists forecast both total and core CPI in April will tick up to 0.3% on a month-over-month basis.
And on the producer front, the Producer Price Index also coming out next week. That's on Thursday. Economists also anticipating both of those numbers to increase to 0.3% in April after last month's declines. New inflation data coming after the Fed held interest rates steady earlier this week, with Fed Chair Jerome Powell saying that the risks of higher inflation have risen.
Finally, we'll be getting another read on the consumer on Friday with May's consumer sentiment. That number expected to rise to 53. That would mark the first increase since December. And that'll do it for today's Market Domination Overtime. Be sure to come back on Monday. I almost said tomorrow. Don't come back tomorrow. Come back Monday, 3 p.m. Eastern, for all of your coverage leading up to and after the closing bell.
But don't go anywhere. On the other side of break, it's Asking for a Trend. I've got you covered for the next half hour with the latest and greatest market moving stories so you can get ahead of the themes affecting your money. Stay tuned.